How did the business perform in the year?
2015 was a tough year for us and was a tough year for the industry, but overall I believe we could deliver a strong performance. We reached a $2.5 billion EBITDA, 15% higher than forecasted, and I think given the fact that oil prices were at $50 instead of in 2015, instead of 100 in 2014, that's a very strong performance. The driver for this is our integrated upstream downstream business model, which actually provides a built-in hedge for the business, high quality, low break-even cost assets in downstream and upstream, and of course the cumulative effects of the efficient improvement programs of the new downstream and next downstream.
And what about the CapEx performance?
We kept a strict control on the CapEx spending. Our spending was at $1.3 billion. Given the strong EBITDA generation and the low CapEx spending, we had very good cash flow generation from the business, which allowed us to cover smaller acquisitions, interest payment, taxes from the current operation, and actually have a stronger balance sheet at year-end than at the beginning of the year. We have now a balance sheet with around 20% gearing. Net debt per EBITDA is around 0.7, which I think it's a very important asset in the current turbulent times. So all in all, I think 2015 was a tough year, but a year which made us stronger.
You had a strong operational performance over the course of the year for MOL Group, but you've taken some impairment charges.
Yes, as I said, 2015 was a tough year for us and for the industry, and ourselves, as others, we also booked sizable impairments. There are two sources of this $1.7 billion. Around $1 billion is the effect of the lower oil prices. We had to adjust the book value of our assets to a much lower future oil price assumptions, and that resulted in this charge. This actually mostly affected our assets in the UK. The other part is coming from the exploration business. Exploration is part of our core business, and unsuccessful exploration projects are a reality of that. Now this year we had one project, the Akribijal program in Kurdistan, what we announced earlier, which was not successful, and that was the major driver for the higher than usual amount this year. Of course, impairments are never good news, but one should not forget that this does not affect the cash position and the balance sheet of the company.
How are you flexing your strategy in this low oil price environment? What are you focusing on?
If 2015 was a tough year, 2016 is not going to be easy either. With oil prices in the $30–$35 range at the beginning of the year, we had to react to this. We already have a program in place to reach break-even in the upstream business in a $35 environment, and of course we will continue our next downstream program.
Can you run through the downstream performance?
For MOL Group Downstream, it had the historically highest and strongest financial performance almost in every quarter and all over the whole year. But our downstream story has started not in 2015. It has started in 2011 when we worked out and we launched our new downstream program targeting altogether $500 million EBITDA improvement starting from 2012 to 2014. And in 2015 we have started a new program called Next Downstream program, when we again targeted $500 million USD EBITDA improvement. And in 2015 we could capture the opportunities given by the external conditions, but on the other hand I can say that 50% of our EBITDA, which has reached in 2015 $1.6 billion, was coming from our internal efficiency improvement programs.
And has downstream margins peaked in your view?
And in 2016, what I say that probably the margins will not be as high as they were in 2015, but the downstream general environment will be still supportive for our industry. And one more positive thing, that I assume that the consumption increase what has started in 2015 it was roughly 5% in our region, will continue to exist in 2016 as well.
You talked a little bit about the EBITDA improvement. How much more improvement is there to go for from the downstream business, and how will that be achieved?
For 2015, I can already announce that we are in a good track. We have delivered more than $200 million EBITDA improvement for our internal sources. So for the next 2 years, we have still $300 million to be delivered. The delivery will be made by the different business units, refining, wholesale, retail. The action plan is there, so I can say that we are on track, and we are very confident that the program will be delivered.
What were INA's contributions to these 2015 results?
Since INA was and is part of the new and the next downstream program, INA delivered a lot of efficiency improvement actions, both in refining, marketing, and in retail area. The fact that INA refining and marketing EBITDA was negative, and also the cash flow was negative, even in 2015, when the external environment was very supportive for a refinery area, shows that without solving the structural questions of the INA refining, the EBITDA contribution will not be positive in INA's case.
Have you seen the results of the downstream expansion coming through?
Definitely. Our downstream expansion was based on increasing our refinery output, petrochemicals output, and mainly to increase also our retail presence in the region. Well, we can see in 2015 that we could increase our refinery production almost 10% overall. We could increase our petrochemical production more than 15% in 2015. In the meantime, we could also finalize our strategical projects. Now we are producing butadiene from our MOL petrochemical complex since 2015 December. These days we are expecting the first polymers coming out from our low-density polyethylene plant finalized in Slovnaft this month. And also we have signed and we have started the implementation of building a new synthetic rubber plant in our MOL petrochemicals together with our partner, the Japanese synthetic rubber company. In retail, 2015, we could increase our sales by more than 10% as well. And in the meantime, has finalized 4 acquisitions during the whole year. And we have 2 more acquisitions for 2016, needs to be finalized, Hungary and Slovenia. Overall, within 2 years, we have acquired more than 450 filling stations in the region.
So all in all, you're confident about the downstream business then going forward?
Definitely. As I mentioned last year as well, I'm pretty much confident that we are on a good track, and also we can see now a good track record, because our target is to continuously improve our internal efficiency. We have good programs for that, so we are very much working on delivering the elements of the business programs. But on top of that, I also wanted to say that in order to make it sustainable, we have decided to deal a lot with our values and to improve our internal working culture, which is based on a new and shared and lived values. A little bit showing and expecting behavioral leadership, because we believe that that is the milestone of making all continuous efficiency improvement programs sustainable for the future and to get closer to a highest level of operational excellence.
How did the upstream business perform in 2015? Because clearly it was a tough oil price environment.
Indeed, tough and challenging oil price environment in 2015. But given the $7 direct production cost that MOL has in its portfolio in upstream, we clearly kind of have seen strong cash generation for a large part of the portfolio. In terms of other highlights for 2015, I would probably mention that after years of decline, we have been able to stabilize and almost reverse the production decline in Hungary. That's among the best results in the past 10 years. And I'm personally very proud of what the team has achieved there. In Croatia, we had even a 7% increase in year-over-year production in 2015, which probably is the best result since MOL took over control in that company.
But given that environment, what's the strategy going to be then going forward?
Well, I think strategy probably builds around 3 pillars at the moment. First one being we want to realize all the upside that is left in the portfolio. We have started to do that very successfully with recent production intensification and optimization efforts on the legacy assets in Hungary and Croatia. In January 2016, our production has reached a year-to-date average of 114,000 barrels per day already, which clearly shows that these efforts are kind of delivering on the ground. We are continuing with an intensified drilling campaign in Russia on the Baitugan asset. We are pushing ahead with some of the development projects in Pakistan. So all in all, we're trying to unlock value wherever we have it in the portfolio. The second pillar is probably removing residual risks. And here the biggest headache for MOL is in the United Kingdom and the UK assets, but it's not only MOL who is suffering. Technically, the entire industry is suffering and pretty much challenged in a $30 environment if you look at the UK North Sea. We are kind of in a position that we need to respond to these challenges together with our partners, and we're working actively on that. And then the third piece is clearly about efficiency. What we have been addressing over the past 4 weeks is technically a new plan for Upstream in 2016. We have been agile and we have fairly quickly adapted to the new environment. In terms of efficiency measures, we plan to have an OPEX cut of 80 to 100 million implemented in 2016. We're cutting back on capital expenditures, roughly 20%. Discretionary expenditures for exploration will even go down by more than 50% in this year. And that's a response actually to the low oil price environment, because the ultimate objective that MOL has is to achieve a self-funding portfolio at today's oil prices of $35.
So are there any plans for growth in the upstream business then going forward?
Well, going forward, we rather want to focus on value than volumetric growth. It's kind of the dollars that count, not only the barrels in our business. And in terms of production growth for the future, in 2016 and 17, we would expect 105 to 110,000 barrel production out of the MOL portfolio. 2018, probably at around 110 and 115. However, all the investments that we make in volumetric growth, organically or inorganically, have to make sense at today's oil prices. And the biggest priority that remains for us in 2016 onwards is to ensure that our portfolio is self-funding at today's oil prices.
So what do you expect from 2016?
Financially, we want to reach similar results as in 2015. First of all, continue with the strong EBITDA generation in an oil price environment above $35. We are targeting above $2 billion EBITDA. We also want to continue with the strict capex control, so we target a $1.3 billion capex for the year. And that should lead us, similarly to 2015, sizable cash flow generation from the business, covering smaller acquisitions, interest payments, and actually keeping our current strong balance sheet during the year.
And what can you say about the sustainability of the dividend?
That's of course a very important question for our shareholders, especially in those times. Now, looking at our results in 2015, looking at our balance sheet and our plans for 2016, I think the financial situation of the company clearly allows to continue our dividend payment practice of the last years. However, as always, the board of directors will meet in March, will make its recommendation to the annual meeting in April, where the final decision will be made by the shareholders.